Most people think you can only make money in crypto if you're glued to charts all day, staring at candles, chasing pumps, entering trades late, exiting early, and slowly burning out. But here's the truth that almost nobody talks about. You don't need to trade every day to grow your crypto. In fact, for most people, daily trading is the fastest way to lose money, not make it. In this video, I'm going to walk you through low-risk, realistic ways to grow your crypto without trading daily, without stress, and without pretending you're a full-time trader. This is for busy people, beginners, long-term thinkers, and anyone tired of emotional trading. No hype, no 100x promises, just smart, sustainable strategies that actually make sense. Let's start with the mindset shift most people miss. Before we talk about how to grow crypto safely, we need to be honest about something. Daily trading sounds exciting, but it's incredibly demanding. To trade daily properly, you need time to study markets, emotional discipline, risk management, experience with losses, and the ability to stay calm under pressure. Most people don't fail at trading because they're stupid. They fail because life gets in the way. You miss entries. You chase price. You panic sell. You overtrade. And fees alone slowly eat your account. That's why so many people secretly lose money, even during bull markets. Low-risk crypto growth is about positioning, not prediction. It's about letting time, systems, and patience work for you instead of trying to outsmart the market every day. Now let's talk about the first low-risk strategy. Holding. HODLing gets mocked a lot, but here's the truth. Almost every long-term crypto winner held, not traded. The key difference between smart holding and blind holding is what you hold and how you hold it. Low-risk holding means choosing strong, established projects, avoiding hype coins, buying gradually, not all at once, thinking in years, not weeks. Examples of relatively lower-risk crypto assets: Bitcoin, Ethereum, strong layer ones, core infrastructure projects. This doesn't mean buy and forget forever. It means you understand what you own. You rebalance occasionally. You avoid emotional decisions. One powerful method is dollar cost averaging. Instead of trying to time the bottom, you invest small amounts consistently, weekly, bi-weekly, or monthly. This removes emotion and reduces risk. You're not guessing. You're building. And for most people, this alone already outperforms daily trading. But we can do better, without increasing risk much. Method 2, staking. Staking is one of the most underrated low-risk strategies in crypto. At its core, staking means you lock or delegate your crypto to help secure a network and earn rewards in return. Think of it like earning interest or getting paid for participation. Why staking is low risk compared to trading? You're not predicting price. You're not entering and exiting positions. You earn regardless of short-term volatility. Popular staking assets include Ethereum, Solana, Cosmos ecosystem tokens, many proof-of-stake networks. Key rules for low-risk staking. Stake only assets you already believe in long-term. Avoid unrealistically high APYs. Use reputable platforms or native wallets. Understand lockup periods. Staking won't make you rich overnight, but over time, compounding rewards can significantly grow your holdings, especially in sideways markets. And the best part? You're not doing anything daily. Now let's go one level deeper. The third method is yield farming. Yield farming often sounds scary, and honestly, sometimes it should. But not all yield farming is the same. High-risk yield farming. Unknown protocols. Unsustainable APYs. No audits. Anonymous teams. Low-risk yield strategies look very different. Low-risk yield farming focuses on stablecoins, blue-chip protocols, transparent systems, conservative returns. Examples include lending stablecoins, providing liquidity for stable pairs, using established DeFi platforms. The goal here is not maximum yield. The goal is capital preservation with steady growth. Even earning 4 to 10% annually, safely, is powerful when markets are slow, prices are falling, or you want predictable returns. But there's an even more passive option most beginners overlook. The fourth method is stablecoins, crypto without volatility. Stablecoins are one of the best tools for low-risk crypto growth. They're pegged to fiat currencies like the US dollar. That means no wild price swings, no emotional stress, no panic selling. Ways to grow stablecoins: lending, savings protocols, on-chain yield products. Stablecoin strategies are especially useful during bear markets, when you're waiting for better opportunities. If you want exposure to crypto infrastructure without volatility, this is where crypto starts behaving more like digital finance, not speculation. You're using blockchain efficiency without gambling on price. Now let's talk about something newer and very powerful. The fifth method is automated strategies and passive tools. Automation removes emotion, and emotion is the enemy of consistent results. Low-risk automated strategies include auto-compounding staking, scheduled investing tools, passive vaults, conservative strategy bots. The key here is simplicity. Avoid tools that promise insane returns, require constant tweaking, hide how they work. The best automation does one thing well, is transparent, is boring. Boring is good, because boring compounds. And while others burn out chasing pumps, your portfolio quietly grows. Now let's talk about risk management, because low risk doesn't mean no risk. Even low-risk strategies require discipline. Here are non-negotiable rules. Rule 1. Never invest money you can't afford to lock. Low risk still means time exposure. Rule 2. Diversify strategies. Don't put everything into one method. Rule 3. Avoid hype. If everyone is shouting, you're late. Rule 4. Security matters. Use hardware wallets when possible. Protect your keys. Avoid suspicious links. Rule 5. Understand before you invest. If you don't understand how returns are generated, don't chase them. Low-risk crypto growth is not about being fast. It's about being consistent and still being here years later. Let's set expectations. Low-risk crypto growth won't make you rich in a month, won't give you bragging rights on Twitter, won't feel exciting every day. But it works. It keeps you in the game. It protects your mental health. It lets crypto fit into your life instead of consuming it. Most people don't fail because crypto doesn't work. They fail because they try to do too much, too fast. If you want to grow in crypto without trading daily, the path is simple. Hold strong assets. Earn passively. Manage risk. Stay patient. And let time do the heavy lifting. If this video helped you, let me know in the comments. Which strategy fits your lifestyle best? And if you want more calm, realistic crypto education, not hype, subscribe. We're building long-term here. See you in the next one.